Non-current assets and depreciation concepts learning quiz. Questions. So 6 or 7 questions to test your understanding of concepts for this lesson. Explain the difference between capital expenditure and revenue expenditure. Capital expenditure is for the purchase of assets that the firm intends to keep for more than 12 months, in other words, non-current assets, and not held for trading purposes. Revenue expenditure is for the purchase of assets that the firm intends to trade, turn into products that it will trade, consume, and for other expenses. Explain what the process of depreciation is intended to achieve. Looking for 2 things. The first is matching costs of using non-current assets against benefits from their use. And secondly, to adjust the value of wasting non-current assets to take the value reported in the statement of financial position down from its original acquisition cost towards their residual value over the period of ownership. Explain how depreciation charges and net book values are calculated under straight line depreciation. A number of steps. Management determines estimates for residual value and useful economic life. Then calculate depreciable amount as the purchase cost less residual value. Then calculate the annual depreciation charge as depreciable amount divided by useful economic life defined in years. And the depreciation charge is uniform over the life of the asset. And lastly, net book value at the end of the year is equal to net book value at the start of the year less the annual depreciation charge, and the net book value falls in a linear way. Explain how depreciation charges and net book values are calculated under reducing balance depreciation. First, management determines estimates for residual value and annual depreciation rate. Next, calculate the annual depreciation charge as net book value minus residual value times depreciation rate. And the depreciation charge and reducing balance starts high and falls off sharply. Net book value at the end of the year is equal to net book value at the start of the year less annual depreciation charge, and the net book value falls rapidly in early years. Then the rate of decline tails off and the value approaches but does not reach residual value. Firms often define useful economic life as a percentage. Explain how to convert the given percentages to years. The percentage shows the amount of an asset that should be depreciated each year, and to calculate useful economic life we need to take the reciprocal. So UEL equals 1 divided by percentage rate. And finally, explain what a firm should do to its straight line accounting estimates to increase reported profits in the short term. So 2 things. First is increase its estimate for useful economic life for its property, plant and equipment. And secondly, increase its estimates for residual value for its property, plant and equipment. And those are the questions which we've looked at for this session.